markets ended the day in negative territory, but here in Europe it's a different story, with stocks edging up from one-week lows. Joining us now to discuss the moves is Philip Vondran, Senior Investment Strategist at Credit Suisse Germany in Frankfurt, and Niku Harachi, Managing Director at K1 Fund Distribution in Hong Kong. Philip, if I could start with a question to you. How do you think the market should interpret this news from Citigroup, the announcement that they're taking $49 billion worth of CIV assets onto their balance sheet? On the one hand, you could say, well, it's a big amount, that's got to be negative. But on the more positive side, perhaps you could argue this is exactly what we've been wanting banks to do, to face up to the negatives out there.
Yeah, that's exactly the case. We expect something like that to happen. And on the other side, we think it will continue that sovereign funds and investors from Asia, Russia, and the Arabian world will support the balance sheets by increasing capital.
Hi, it's Lisa in Singapore. Let's get your reading on the Tankan out of Japan this morning. I mean, the market took it as bad news, but there were a couple of bright spots in there, especially when you look at capital expenditure and the outlook for the smaller companies. What was your overall feel for the Tankan report?
Well, the Tankan report came out yesterday, and as we saw, it fell from 19 points. So it fell to 19 points from 22 in September, and we are indicating that we will see a lower number even coming out next year in March, targeting around 15. We think that the Japanese economy isn't looking too good. In fact, I would actually say from a whole point of view in Asia, this is the one country or sector, or even their sectors, that we will stay out of. As I said, we do expect a slowdown in the Japanese economy, but we expect a mild slowdown within the next 1 to 2 quarters. We think we're going to see the yen starting to increase in value. And so far, we've seen very high material costs and obviously also energy costs. So for the next coming 2 quarters, we would stay out of Japan.
Philip, let's talk about the coordinated liquidity infusion that the Fed announced earlier this week. Essentially, a lot of skeptics out there saying that it did not work, and there are other potential things that the Fed could be doing going forward that could actually deliver the kind of liquidity and the kind of jumpstart that this market needs. What in your sense where can the market go from here, and what can the Fed do to make it, give it some juice, give it some steam ahead?
Yeah, I think it was a first step in the right direction. Perhaps it was a bit late, but it was a coordinated action, not only the Fed, all the central banks in Europe and also some in Asia participating. It's the first step, more is to come, but you have seen that at least the credit markets and the fixed income markets have reacted to that. And when walking through our trading floors, it's always very striking that rather the fixed income traders are absolutely nervous than the equity ones. And so I would argue a reaction from the bond side and from the fixed income side is worth much more than on the equity side. And the reaction was positive. They wait for further action in this kind of segment, rate cuts, more liquidity provided by the central banks. But we think the right step has been taken.
Just to bring you some breaking news, Gordon Brown, the UK Prime Minister, is arriving at the EU summit. That's a summit taking place in Brussels. I think he just disappeared in through that door. We might pick him up as he moves through the proceedings. We'll have more, of course, from this summit that's taking place live in Brussels as the morning goes on. There he is, just shaking hands, I believe, there with the leader of Portugal. But Niku, if I could get back to our discussion, you've been talking about Japan already this morning. What about the rest of the Asian markets? A lot of investors seem to be crossing their fingers and hoping that the decoupling theory really holds true, and that we will not see the weakness in the US markets spread through into weakness in the global economy. Is that a theory that you buy into?
Well, I like your point of view, saying a lot of people is crossing their fingers, and I think that is actually what the investors have been doing here. I think that since the beginning of 2007, this market has been an asset-driven liquidity bubble. And why do I say asset-driven? Well, I think that we have been seeing so much easy money being poured into the Asian markets. I, as a matter of fact, think that this will stop. The reason being is that we're seeing the highest lending costs that we've seen in 7 years. So I think that the easy money, they are going to be pulled out and not continue. The second thing is also volatility. We are seeing the highest volatility we've seen in 5 years. And if we look at the VI index, which is a measure of volatility, it actually didn't come as much down when we saw the recent 2-day rally as it's supposed to be, or we've usually seen in the past, actually showing that the market makers anticipating that this short-term rally we saw is not going to be sustainable. And maybe the last thing is that even though we've seen the markets correct a little bit, we're still having such high valuations that if the markets were to continue with the same kind of returns we saw in 2007, we would have to say corporate profits coming out between 40 to 50% in 2008, which we don't think is sustainable.
Niku, thanks very much for joining us. Niku Harachi, Managing Director at N1 Fund Distribution, and Philip Vondran, Senior Investment Strategist at Credit Suisse Germany. They'll be back, of course, with us after the break, but also coming up on the show, we have November inflation data for the European Union. The EU-wide consumer price index is out in less than an hour. We'll ask our guests what it means for interest rates on both sides of the Atlantic. Meanwhile, these are some live pictures coming through from Brussels, where European leaders are gathering en masse and basking in the afterglow of signing the Lisbon Treaty. Why are they smiling? I think we can detect some smiles there. We'll be in Brussels to find out more very shortly.
You're watching Worldwide Exchange. These are the top stories today. In Asia, business sentiment in Japan falls to its lowest level in 2 years, fueling fears of a slowdown in the world's second biggest economy. In Europe, oil and money, financials and energy stocks are the gainers as markets rebound from yesterday's losses. And in the U.S., Citigroup takes a bold action, shifting billions of dollars of troubled SIV assets into its balance sheet.
Let's return to our strategy panel now. Philip Vondran, Senior Investment Strategist at Credit Suisse Germany in Frankfurt, and Niku Harachi, Managing Director at N1 Fund Distribution in Hong Kong, join us. Let's start with you, Niku. First of all, New York Fed's Dudley yesterday basically saying that the TIPS market is going to offer a place of safety in this time of market turbulence. We just heard also that the PPI is at its largest level, wholesale prices, inflation at their highest level in 34 years. What's your take on the TIPS market right now?
Well, if we look at if we're being asked of the overall U.S. economy and if there are some sectors in the U.S. that we like or which markets are not, of course, obviously, though, you could always do the sector pick or the stock pick, and it could be the star of the day. From our point of view, we don't think and we don't favor the U.S. economy. We think that there are too many hidden things that has to come out on the table. We still have to see what is the real valuations of the subprime markets going to be. Are we going to see a spillover into the consumers? What's going to happen? I mean, we're seeing a lot of volatility. We're still seeing high valuations. From our point of view, is that we have said is that sit tight, stops, and try to get out now, and let's see what's going to happen in the first quarter of 2008.
Nico, going into the break, you were predicting a mild slowdown for the Japanese economy and possibly a stronger yen. What's your take on how investors should be approaching Japanese stocks right now? Because some say the cue to buy, the cue to jump in, is when the yield on the dividend yield in Japanese stocks surpasses the yield on JGBs. We're there now. Could this be a buying opportunity?
Well, you could always find a buying opportunity if you were looking hard, but I would say there would be many other markets that could be more interesting. I think that the Japanese market and also the policy makers, they have to find one direction. They should actually, from their point of view, stop fighting and get the Japanese economy on track. Once they've got that, then they will actually increase investors' confidence. And I think that once you have increased investors' confidence, they will come back to the market, and then hopefully we'll also see the Japanese yen will go down, so it would be better for exporters. But as of the current stage, I would not invest or advise to invest in the Japanese market.
Niku, what kind of valuation metrics are you looking at right now? I'm asking because, of course, we've seen such retrenchment in share prices globally, to some extent at least. corporate earnings are holding up to varying degrees across the globe, but I wonder how meaningful earnings valuations are, for example, or asset valuations are in the current climate when the markets seem to be hijacked, if you like, by poor sentiment and poor US data. What are you making of valuations at the moment?
Well, as I said before, I think that the valuations are still much too high. Having said that, we do have long-term stories that could be very good. I still think that local-oriented demand strategies in China could be very good. Should it be the insurance business or should it even be the healthcare business? So from that point of view, you can still find some sectors that have high valuations but probably will sustain the returns in the next coming years. But the overall market, as I said, I still think that we are seeing too high valuations. We are seeing, as you said, very negative sentiment. So I don't think it's going to continue in 2008.
Philip, if I could put a similar question to you, what kind of valuations are you looking at right now? Do you think that markets are overvalued? Do you see opportunities, or do you think that talking about valuation is a waste of time in the current climate?
No, we absolutely don't think so. When looking into our input factors for the asset allocation process, valuation is clearly a supporting one for the equity overweight. However, and I think that's something which we have to keep in mind, it's extremely diverse through regions. Latin America, Asia, the situation is looking less attractive, whereas you have Japan and Europe, where the valuation is clearly pointing to a more positive picture. However, the valuation is only one side of the coin. The other side is the earnings dynamic, and interesting enough, the countries where you have interesting valuations, the earnings dynamics look the worst and vice versa. So the impact our earnings and valuation models provide to our asset allocation is a slight overweight in continental Europe and still one in emerging markets. However, we are absolutely nervous about the valuation side there.
Many thanks to Philip von Druren, Senior Investment Strategist at Credit Suisse Germany, and Nick Kuharachi, CEO of Edmond Asset Management.